Bitcoin is the best performing asset over 1, 2, 3, not 3, 1, 2, 4, 5, 10, 15 years. 3-year number is not very good because there's been volatility.
Yusko begins by highlighting Bitcoin's remarkable performance over the past 15 years, positioning it as not only the best performing asset, but also the lowest correlated. He underscores Bitcoin's zero correlation to bonds, emphasizing the significance of its independence from traditional asset classes. This lack of correlation implies that Bitcoin's movements are not influenced by macroeconomic factors affecting bonds or stocks, making it a valuable diversification tool within investment portfolios drawing on statistical insights. Yusko elucidates the impact of incorporating Bitcoin into investment portfolios. By allocating even a small percentage to Bitcoin, investors can enhance their portfolio's risk-adjusted returns, as measured by the Sharpe ratio. Yusko presents compelling hypothetical scenarios, demonstrating how incremental allocations to Bitcoin can yield significant improvements in portfolio performance over time. This underscores the potential benefits of embracing unconventional asset allocation strategies and diversifying beyond traditional asset classes.
Bitcoin is not only the best performing asset over the last 15 years, it's also the lowest correlated asset. It has 0.0 correlation to bonds. What does that mean? All that means is that if bonds go up, you don't know what Bitcoin's going to do. If bonds go down, you don't know what Bitcoin's going to do. They're totally uncorrelated. Doesn't mean negatively correlated. It doesn't mean one zigs when the other zags. It just means there's no information content in what bonds are going to do and Bitcoin's going to do. And Bitcoin is 0.15 correlated to stocks. So when you add it to a portfolio, the return per unit of risk, the return per unit of volatility, the Sharpe ratio, goes up more than anything else. So if you had just taken 1% a decade ago, right, and put it into Bitcoin, your portfolio, instead of compounding at 9, would have compounded at 11 with less risk. What if I'd taken 2%? Then you would have compounded at 3% higher. What if I put 5%? You would have compounded at almost 10% higher. Now, this is not promissory. That's not saying this is going to happen in the future. But what it says is that we have this asset. And the reason it's uncorrelated is because stocks, bonds, etc., all rely on the same thing. They rely on interest rates, GDP growth, demographics, inflation. Okay. Bitcoin doesn't rely on any of that. Bitcoin is all about the digital divide. I tell this time, ask anyone over 35, who's your broker? Oh, I don't know, UBS, Merrill Lynch. Why? How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Oh my gosh, 0. Are you kidding me? It's a Ponzi scheme. Haven't you heard that Peter Schiff guy? How often do you use DeFi? What the heck is DeFi? What are you talking about? Okay, ask anyone under 35, and DeFi stands for decentralized finance.
Right.
So ask anyone under 35, who's your broker? What's a broker? I mean, I have a Robinhood account. Okay, how much gold do you have? Whoa, are you kidding me? Boomer rocks? 0. Haven't you heard that Peter Schiff guy? How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really big percentage of my net worth. I'm kind of embarrassed. How often use DeFi? Every day. So that digital divide is real. And I say this all the time. I do have the problem. So I have 3 grandkids, and 1, 3, and 5. And my 1-year-old granddaughter is a Zoomer, right? She's a Gen A. She will never have one of these. She will never have a leather wallet. She will never use paper money. She'll probably never drive either. But she'll never know what paper money is. She'll never know why you would have a wallet. She'll have a digital wallet and she'll have digital currency. And the easiest example is, imagine in the future, and probably not that distant future, you're in the back of the car, and the car's driving you, and it pulls into the fast charging station. It won't take 45 minutes. It'll take 4.5 minutes. You won't get out of the car and put a plastic card into some machine. The car will pay the machine. It'll pull away. You'll get on the freeway. You say, you know what? I want to go in the fast lane. So you pull in the fast lane. It won't take a picture of your license plate and send you a bill for $4. The car will pay the machine. Okay. And so these microtransactions will happen in real time over blockchains, and we'll have a digital currency, most likely Bitcoin, because ultimately all Bitcoin is a ledger, right? It's not little tokens, it's not little gold things, it's a ledger.
Right.
And a ledger that is secured by the most powerful computing network that the world has ever seen. Right? It's been up for 15 years. It's been down for 20 minutes in 15 years. It's never made a mistake. Here's a crazy thought. How many times people listening to this had to get a new Visa number, MasterCard number? Plenty. Why? Well, I'll tell you why. Because Visa and MasterCard today run on a mainframe computer. Not even a microcomputer or a personal. They run on a mainframe computer coded in COBOL.
Ooh.
Okay? Now,
that's a word you haven't heard in a while. Yeah.
Why? Well, to change it would cost a lot of money. Yeah. And they say it's actually kind of a moat because no one knows how to hack it. The problem is a few people still do. And so they do get hacked. And that's why you have to get a new number. He says the only problem is when it breaks, we got to put a light on to Sunnyvale Retirement Home and some 80-year-old has to come over and fix it because the only people who can code COBOL are 80, which my dad's 86 and could code COBOL. So he would agree with that. So ultimately, again, this is a long-winded way of saying Bitcoin is here to stay. Blockchains are here to stay. They're as inevitable as the internet.
Yusko delves into the generational divide in attitudes towards digital assets, illustrating the contrasting perspectives of different age cohorts. He juxtaposes the skepticism of older generations towards Bitcoin with the enthusiasm of younger generations, highlighting the evolving nature of financial paradigms. While older individuals may dismiss Bitcoin as a Ponzi scheme, younger generations embrace decentralized finance DeFi and view Bitcoin as a legitimate store of value. Yusko paints a vivid picture of the future, envisioning a world where digital wallets replace leather wallets and transactions occur seamlessly over blockchain networks. He emphasizes Bitcoin's role as a ledger secured by robust computational infrastructure, contrasting it with outdated legacy systems plagued by inefficiencies and vulnerabilities.
What you want is a collection of the highest volatility assets that are uncorrelated. Like if you want to minimize your volatility, put it all in cash, which is the dumbest thing you could ever do because you'll wake up with less wealth because inflation will steal it all away. So you can buy something that's a little more volatile, bonds, and maybe you can keep up with inflation. You can buy a little more volatile stocks. But here's the myth about volatility. Volatility is not risk. Volatility is simply disagreement about the future prospects of a business. So I'll give you an example. Amazon.com and Bitcoin have the exact same volatility, 80. This is amazing. Wow. Amazon's been a public company for 27 years. In every single year of those 27 years, they've had a double-digit drawdown, including this year. Okay. On average, 31%. Meaning, on average, you lose a third of your money every year, in theory. But when was the right time to sell? In fact, twice you lost more than 90%. But when was the right time to sell? Well, never. Well, who bought Amazon.com on the IPO and held it to today? There's only 5 people. Jeff, mom, dad, ex-wife, Bill Miller. Bill Miller's cost is 7 cents, right? It's 100. Actually, no, it's less than that. It's 0.7 cents because you just did a 10-for-1 split. So 0.7 cents, and it's worth $177. So he was the only one that got that volatility didn't matter. What matters is the long-term accumulation of the network value. Same thing with Bitcoin. Bitcoin is the best performing asset over 1, 2, 3, not 3, 1, 2, 4, 5, 10, 15 years. 3-year number is not very good because there's been volatility. But that volatility corrects itself over a long enough time horizon. There's no 4-year period in which the return on Bitcoin is negative. None in 15 years. What Bitcoin is, it's the perfect savings technology. It's deflationary money instead of inflationary. So whereas every dollar I get paid for doing my job, converting energy to value, the government slowly steals it back from me. over a 30-year period at 2%. They take half my purchasing power over a 30-year period. That's crazy. Okay. With Bitcoin, every dollar I save in Bitcoin over the 15 years has gone up in value, but it actually hasn't. This is the genius of it. One Bitcoin is one Bitcoin, but we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars, right? So the dollar has been getting less good. So the money gets worse. And so here's something that most people don't think about. Everybody's all like, stocks are all-time highs, right? Only if we price in dollars. Today, US equities, the S&P 500, priced in gold, is the same price as 1996. Because the money is getting less valuable, and the things that store value, gold and now Bitcoin, are holding their value.
Central to Yusko's thesis is the notion of Bitcoin as a deflationary savings technology, offering a hedge against the erosion of purchasing power inherent in fiat currencies. He highlights Bitcoin's fixed supply and its potential to preserve wealth over time, contrasting it with the inflationary nature of fiat currencies. While traditional currencies gradually lose value due to inflation, Bitcoin's scarcity ensures that its purchasing power remains intact, if not appreciates, over the long term. Yusko dispels the myth that volatility equates to risk, citing examples of high volatility assets, such as Amazon and Bitcoin, that have delivered exceptional long-term returns. He emphasizes the importance of focusing on the underlying network value and long-term accumulation strategy, rather than short-term fluctuations in asset prices. Please like and subscribe my channel.